Friends, in this video for I Thought Wealth, I am going to talk to you on the topic cheap stocks getting cheaper and costly stocks becoming costlier. There is nothing new in this trend. In every market cycle, we see this, that stocks which are expensive become super expensive and stocks which are cheap become cheap. Naturally, those who have tasted the success of owning expensive stocks tend to believe that cheap stocks deserve to be where they are and they deserve to be cheap, and there is a good reason for them to be cheap. So in every cycle we see this, but interestingly, when we think some stocks deserve to be cheap at the end of a long cycle, they very well become the darlings of the stock market in one or more of the subsequent cycles. So this we have seen in every market cycle. In 2008, we saw that FMCG was slowly getting into the doggos of the market, so was pharma. But today you are seeing that both these sectors are very much fancied and the market loves them. Around 2015 to 2017, we saw that tech was really not fancied. Most people believed that the growth story in tech was over, and they became progressively cheaper and cheaper. But today you are seeing that tech companies are among the most expensive part of the market. So over a period of time, it could be 5 years, it could be 10 years, it could be 15 years, what we believe are cheap stocks for a good reason and deservedly so also turn out to become the most expensive stocks in the market, and people also buy them at such a pace that they make it more expensive, right? So this is not new to us, this is not uncommon, this is something that repeats time and again. So today we are seeing the same trend. One set of companies are very expensive and they are still becoming more expensive. And when you backtest the most expensive companies at their most expensive moment, all your hypotheses will get validated by that backtesting, because the extent of overvaluation, the excesses of valuation will support any investment hypothesis, right? And similarly, when you backtest the cheapest stocks at the bottom of the cycle when nobody is touching them, you will see that their past performance, which you extrapolate, will give you data which can support any hypothesis. But yet, it is these hypotheses which get defeated after 5 or 7 years or 10 years. So we don't know when the hypothesis will be defeated, but time and again, this kind of investment hypothesis, ably supported by backtesting of data, has been defeated by the market. So that is something which is also a common trend in our markets. So I believe that today what we see as super expensive stocks may not sustain as super expensive stocks, because it is difficult for companies to sustain performance for such extended periods of time, especially in businesses which they are in, which could face cyclicality, global impact, and a lot of changes in supply and demand. Similarly, businesses which are in the doggos today can turn out to become the most expensive stocks, because when a business is not seen as worth investing, they don't attract capital, new capacity doesn't get created, a lot of capacity gets destroyed. You also see consolidation of players. You will see that these businesses tend to become more efficient, because just for the sake of their survival, and then over a period of time they start seeing better times and good things keep happening to them, and then it becomes a virtuous cycle and you see them as the most expensive stocks. Those of you who are seeing these super expensive specialty chemical companies today must understand that they have gone through all these things in about 10 or 15 years, and the companies have been literally going through a phase of continuous change, improvement, betterment, reinvention of the business, making the business model more futuristic, creating new products, incrementally improving technology at lower cost, making products which are new with marginal incremental investment. All these good things have been done by these companies, but we are not seeing all that. We are only seeing the fact that in the present, these companies are showing superior performance, their financial metrics are superior, their growth metrics are superior, everything looks good, and therefore we believe that they are destined to be the expensive companies and the super expensive companies of the market. Similarly, we are also seeing the cheap companies in a light which does not look good to us. It looks like they will never be able to improve their metrics. There is too much of capacity. They are not going to see operating leverage kick in anytime soon. We believe that they may actually be in businesses which could face phases of redundance or obsolescence. We are seeing that, right? And ESG has come and made it even more difficult. But time and again, we have been forced to revisit our conclusions made under extreme market circumstances based on extreme interpretation of data and extreme sense of being opinionated. It is this aspect that I want to draw your attention to. Do consider these points, be sensitized to these prospects, because in every cycle these things repeat, and I would not want to enter into an argument on or a debate on any companies, because that becomes personal or it relates to people who have been successful in identifying that. That is not the object of this video. The object of this video is to sensitize you to these probabilities which rhyme, repeat with history. That is the base point, and do stay with us on this course of learning, and thank you very much for watching this video.